Hello and welcome to this special episode of Market Masters on CNBC TV18. My guest today is what I call an all-rounder, someone who is an economist par excellence, a stock picker and a gifted singer. Yes, we're talking about Manish Chokhani, director of Enam Holdings. Manish, thank you so much for joining us here.
Anuj, I only agree with the third one, not the first two.
The third one you can't disagree also. For those who have seen or who have heard your songs, it's, yesterday in fact I was hearing your song and, it felt like Hemant Kumar had, just come back into the world and he was singing. It was that good. But no, Manish, you are being modest. I think you're someone who has, a good pulse of both macroeconomics and picking stocks at right prices. I'm going to start with the macro because that's what is most important right now. We have had an election in which the market, in the end, perhaps got what it wanted, but there was a bit of a scare.
Of course.
So, how did you read that outcome, and does that change anything for the market?
No, well, the markets already voted that they think it now is continuity. And while the outcome wasn't what the market expected, I think the market had baked in that there will be at least a simple majority of the ruling party and the NDA will come back with 300 plus. So this lower number of seats certainly spooked everyone. And then when the realization dawned that it's two very senior coalition partners in Chandrababu Naidu and Nitish Kumar, who are both probably towards the end of their career and little bit more likely to be statesman-like and looking for development of their states rather than what they can extract for themselves or their families, I think the market has calmed down a lot of it. And remember, Chandrababu was the original CEO CM who put the whole developmental plank and agenda in front of the country. So I think on balance, markets taken it well. Policy continuity looks to be in place. Of course, things will be a little more contentious because the breakup of parliament is now not so one-sided. And maybe in its wisdom, that's what the Indian public wanted, that there is some checks and balances. While we still like what has happened, maybe that's really what was desired.
We want PM Modi, but not with the brute majority.
Absolutely. So maybe I don't know. I mean, we are reading now post facto.
Post facto, yes.
But maybe that's what really, in its wisdom, the Indian public seems to have wanted. But doesn't seem to distract from the fact that what was achieved over the last 10 years in terms of fantastic infrastructure development, very, very great national security, internal security, the great speed and transparency of what was happening on administrative, IT, the digitization of India, the GST reform. So a lot of good things have happened and one is expecting continuation of that to make, as I say, velocity of doing business in India faster and easier. And that's really what the market seems to be signaling and the world seems to be expecting from us.
Okay, since we are on the topic of macro, a couple of other issues that I want to discuss with you. Currency volatility in India has completely died. It's almost as if the currency market on a day-to-day basis is not trading. And B, we have seen continuous FII outflow, at least from the secondary market, and that gap being filled by the retail investors. What do you make of that?
No, so two things. On currency, it's a different game because what the West has continued with its printing, and even while the central banks signal that they are doing a reversal of quantitative easing, the government balance sheets have started deteriorating because the fiscal balances are going absolutely crazy. So I don't think monetary tightening is happening anywhere in the world. And that is what is reflecting in commodity inflation or the rigidness of inflation which is happening in the world. And because the world knows there is a lot of inflow eventually going to come into India, the currency is expected to actually appreciate, and I think we are doing the best to keep it down. Whereas other currencies in the region have all started again falling. The Indian currency has remained very strong despite, as you say, some outflow from foreign equity investors, because inflows on debt side, remember, are going to be very strong. And it's almost inevitable in my view that the equity investors from overseas who are waiting for a break in Indian prices never got it. But any dip in this market, I think there's a wall of money heading our way.
You say that because of the bond inclusion?
Bond inclusion has happened in all the indices, and I think a series of that will continue. And same way in equity indices also, it's almost inevitable that India's weightage starts going up because our the index share compared to GDP share, I think lots more, we're still like barely sub 2% on the indices. And remember, markets tend to vote on future profit potential of our economy. And the Indian economy at 4 trillion and whatever 5% profit share at 200 billion is not the sum and substance of what India will make. So over the next decade, definitely I expect our currency to be substantially stronger. It has to be actually a freely traded convertible currency, and moves are already being tried in that direction. But I don't think that day is very far where you'll be able to go out and actually not say I have to carry a euro and a dollar with me, but hopefully you could go and do all your buying overseas using Indian rupees. But anyway, that's for later.
That's for
later.
another day. You said
Yeah.
that FI money will soon come to India. When will that come? Because we've been waiting for that.
So, well, I was listening also very keenly to the Morgan Stanley folks who really have an edge on this. But, and I was also in Europe, last few weeks. I think the amount of interest in family offices and people with substantial money, and even the retail, because they have all now heard that India is the next thing. And I do think, and I've been saying this for some time now, that India will be a repeat of what happened to emerging markets in 80s when Japan and Taiwan took off, and those markets went 10 to 12 times and became a bubble. Same thing happened when China took off, and that market also indeed went into a bubble and then has been correcting ever since. The conditions are such that India will create a bubble. And maybe retail is kind of smelling it. The institutional investors are obviously, they have to rotate their money as private equity and so on, those are the fellows selling. But when you get a wall of money, and largely it comes through ETFs and passive flows, they tend to be price agnostic. So as and when this happens, and I even read Ashish Chauhan saying that the Japanese have launched a ETF, and the money which then comes, because the wealth in these countries which is earning very, very low yields and doesn't see a lot of growth prospects in the economies is very large. So one can't time it, but I wouldn't be surprised you get like 50 and 60 and 70 billion dollars of inflows coming to participate in a market which, in the context of a $4 trillion market cap, is not something so crazy, but it just creates that final climax.
So that is very interesting, because Manish, you know what, at the end of the day, the most money is made when you are actually entering the bubble phase, right? Now the issue is, you gave the example of Japan. Japan never touched its highs for 40 years.
That's right.
So are you saying that in next 5 to 10 years, we could be headed that way, that we have the index going up maybe 8, 10 times, and then
So
for many years creates
see,
a
that's both a, how do I say it, it's a opportunity as well as a fear, that the country needs to absorb that kind of capital to use it to grow. So it's possible, because a lot of people know this history the way I do, it's possible that the larger companies then go out and raise $10 billion directly in primary issuance, rather than that money coming into secondary market. That itself would also help to create, in a sense, a real bubble.
absorb some of that.
Secondly, I know our regulators and the ministry also should be aware of this, that you don't, as an investor, even I don't want a bubble.
Yeah.
Because you get, great returns in a year, and then you spend the next 10 or 20 years making nothing. So it's great if it doesn't happen. But all I'm saying is, looking at the conditions and the speed at which this market now works, and the way the computers are now programmed, and the way the flows are into ETFs and passive price agnostic funds, I don't see how, whenever it happens, if it happens, one will be able to prevent this from happening. So the only response, the fastest response doesn't typically come from regulators, it comes from private sector. And my belief is the private sector will participate by raising $10 billion. It could be, for example, it could be a Reliance or an Adani going and doing a $10 billion raise each for one or two of their entities. And that could absorb the capital, because capital clearly wants to come into India.
Okay. What about retail? Because we, all through the 2000s and early 2010s, the belief was that retail always comes in at top.
Right.
And this time it's been different, and refreshingly different.
But it's even been a top now. So it's rising top, rising bottom. So why do you say retail has come at the top?
No, I'm saying this time it's different, because retail has managed to not only come at good levels, but stay put. And the best example was the verdict day, when you saw so much buying by retail.
That's right. Yeah, that's actually true what you say, that on the day of verdict, maybe the foreigner was very excited that if things go a bit awry, we can get invested into India. Because by and large the country will go on its trajectory. And retail didn't give you a chance, because that money just quickly came in. So you're right in what you're saying. And therefore, as I say, if retail doesn't let up, and it doesn't look like it will, the domestic money anyway doesn't have anywhere else to go. It will, the domestic as in family offices and so on. And the foreigners are very anxious and desirous of coming in. So anytime they see a small break, or with some passage of time, you see that money coming in and there's only buyers from all three sides and there's no seller. That's what I call the conditions for a bubble to get created. Which is why I think it's likely. I hope it doesn't happen because bubbles, while they are exciting on the way up, they are devastating on the way down. And then the aftermath is very, very bitter. So I hope it doesn't happen.
But we are still some distance away from that.
So Anuj, what's happened is small cap, mid cap have actually experienced a bubble because some of the prices are just fantastic. I don't think
we are already in
I
bubble
think
in
some
small
of
cap?
those prices people will not see 10 years later. The companies will perform. Don't get me wrong. I'm bullish on our economy. I think we get to number 3, and eventually in this century we will be number 1. We will be the largest economy in the world. I also feel there is money to be made in our markets over a decade. We make 3 to 4 times on the index every decade, depending point to point. But if from this point you think on mid cap, small cap, you have to make money, you have to think of a decade ahead. I don't think over the next 3, 4, 5 years, you should be thinking I'm going to make this kind of return here. The index, however, and why we are still okay, is the index constituents haven't really participated. So the larger ones, as I said, the Reliances, the IT, the banks in particular, they haven't participated in this. And that climax finally when foreigners come in and they have to deploy large money, it typically comes into the top 100 stocks. And that's when you finally get the parabolic rise.
No, that's the paradox, right, Manish, right now, because for an investor, you might be thinking an HDFC Bank right now perhaps represents a far better value than, say, a defense stock or an EMS stock. But, an EMS stock has still given you 30% returns in 3 days, and an HDFC Bank is still where it is. So, how do you make that decision in that case?
So, look, if I look back 3 or 4 years ago, I remember on our shows we would talk about exactly EMSs or PSUs and so on, and they were dismissed that
The
these
hated
are
space.
inferior businesses, not good businesses and so on. And it's from those spaces when the earnings get delivered and the surprise comes that the P also changes. So you got a double effect in all the spaces that we talk about. PSUs in particular have led actually this rally. Power, infrastructure, real estate, which were the hated stocks of the last cycle of 2008, have actually led in this rally because in cyclical upturns, these are the types of companies that perform. Having said that, as an investor, you should always be thinking what's the hated space in the market today, not what was great yesterday or 1 year ago or 2 years ago. So from that perspective, again, I draw back to history. Infosys was a great business in 2000. The stock did not perform for 10 years. The business did brilliantly well. The stock did not perform for 10 years. Prior to that, Hindustan Lever has experienced it, where the stock did not perform for 10 years, from 98 to almost 2007 or 8. And similarly, Reliance also, which had led the 2007 bull market, did not perform for 10 years and then it quadrupled in this last period.
Yes.
So a lot of these companies, as I say, they have done well, they will continue to do well, but the stocks may actually not do as well in the coming few years. That gives you a chance, if you indeed want to rotate, to go into something which is a little bit more hated today, because if this market is going to continue climbing, it's a rotational market. It's not only a sector which can lead. It will keep rotating from sector to sector, and therefore the final climax has to be made where people haven't participated. And the largest money, in a sense, has to get made in financials, because that's where the bulk of the index weight is also.
All right. Well, let's do one thing. Let's take a quick break. We'll come back and resume this conversation with Manish Chokhani. Welcome back. Well, I'm in conversation with Manish Chokhani, and before the break, we were giving you some examples, and just from example point of view, let's look at HDFC Bank, which is right now perhaps, as we would call, perhaps in the hated category, not given any returns for last 4 or 5 years. A stock which used to trade at 4 times, 5 times price to book, available at 2 times price to book. I mean, what's going on here? I mean, purely as an example, and do you think at some point perhaps some big investor would say, okay, enough now, let's just go out and buy it?
See, it happens. I remember the famous case of ITC. 2 years ago, everyone said ESG funds, tobacco, nobody can buy it. Why should they touch it? And it was languishing at 200. Today, it's 430. And it's a large cap. In fact, ITC today, you'll be shocked to know, is the same market cap as BAT, the parent. Same way, a few years ago, there was the dominant narrative that Maruti has no future, small cars are over, EVs are coming.
Yes.
What will happen? Will the company get acquired by Toyota globally? Today, Maruti's market cap is double that of Suzuki. As in, Suzuki effectively has a zero market cap because it owns half of Maruti. So these kinds of anomalies in the market do occur, but when they get corrected so swiftly that you are shocked with what has happened. And again, for context, the HDFC Bank market cap was made by Apple in one day. When it rises 7% on a 2 trillion market cap, that's 140 billion. So while the numbers look very large, and you say, how can any, we used to say this for Reliance, no, it's so big, it's 10% of the index, how can it go up, nobody can buy it. When it moved, it went up 4x.
But then
So these things happen, and again, I'm not making a case for any stock in particular.
absolutely, yeah.
But all I'm saying is that the financial space has lagged this market because earning momentum has been elsewhere. It was a lot of correction which happened, and largely the excitement was PSU banks because they went from whatever 25-30,000 crore profit to almost 2 lakh crores. There was a time when HDFC Bank was equal to the entire PSU banking space.
Yeah.
That was also a reality. And today it seems to be swapping. PSU banks profits have gone up, multiples have not gone up because still the old fear is there of telephone banking. But if the narrative of PSUs is true, that they are now run efficiently, there's no more telephones coming in from Delhi or wherever, and if we can buy HAL or BEL and whatever on 40 multiples, it doesn't stand to reason that BOB, UBI, Canara would continue to trade at 1 time, 1.2 time book or 7 time multiples. So these things will change over time, but it's as an investor you have to have patience to, as I said, you buy mispriced odds. If you buy the horse, as Charlie Munger used to famously say, the horse which is supposed to come first, if he comes first, you don't make any money because you are betting the odds.
Yeah.
But you bet on a horse number 13 who comes number 8, you make far more money.
Yeah.
And that was the narrative for mid cap, small cap also, that they all perform better than they were expected in this upswing. But the large opportunity for money making remains in large sectors, which are large profit pool sectors.
No, but
and that's the only argument I'm making.
you know, so that's my next question then. You know, it's always a battle in your head, right? Momentum is making you money,
Right.
value is not right now. So how do you approach this market? Do you wait for that turn, or do you start to position yourself right now itself, lighten yourself
let
in
me
some of the
only
momentum
drawback
stocks?
from history. So I don't think whenever we also buy stocks, we don't think it will become momentum stock. A lot of our stocks have ended up becoming momentum stock. So, and Manibhai, who's our founder, he used to say this very well. He's saying you should always be a buyer of value and be a seller in momentum. So as in you buy what is hated. Like today, if I'm holding a momentum stock, I would continue holding it because there you then start looking at technicals, that is it making higher rising top, higher rising bottom formation. So as long as it's higher top, higher bottom, it's fine, ride the momentum. But the day you see that break, don't try and convince yourself about the fundamentals of that. Then be merciless in selling. And that's what I mean, that if today you have bought a stock and been fortunate to participate in a 8p stock becoming a 40p stock, nothing stops it being a 60p stock. It could well go there. But when it turns from 60 and it starts falling, then be merciless because eventually this will settle at a 20p. So the speed of, like if you are holding stocks today, and like I said, I do expect India to get into momentum territory. Don't change your horses midstream. Continue holding because at least your cost base in what you're holding is low. So when it turns and you do sell it and you may not get the top, you don't feel and don't beat yourself up that, oh my God, I sold it cheap, or I got burnt on it, or I lost money. Because if you sell something which you bought cheap here, you will end up buying something also which is expensive, and when that falls, you're going to lose a lot of capital. So that's all I can say on that perspective. However, as a buyer, you should always be thinking, do I have a double dip in a stock where earnings can go up as well as multiple can go up? That's the logical way to approach buying.
Okay, Manish, where do you stand on commodities now? Because that's one area where a lot of people are debating whether it's a super cycle, whether we are already in the middle of a cycle, and how do you approach stocks here? Because we have the example of 2000 to 2010 when we had this massive surge in commodities.
Yeah, so it's a great question because I think in terms of cycles, if you think after the world went to the Bretton Woods standard and they broke the peg to gold standard, we create a bubble every decade. And in the decades, if you look back from the 70s, it went into first the Nifty 50, but it then transcended and went into commodities. And that was the famous era of Hunt brothers who made their killing in silver. And oil went to crazy heights and it topped out in 1980. It then translates in every decade between technology or growth stocks and then commodities or emerging markets. That's typically the changeover which happens. So you take it from commodities to EMs of Japan and Taiwan in the 80s. In the 90s, you see the climax of NASDAQ, again technology. 2000 to 2010, you again saw it back to commodities and EMs like China, which led. 2010 to 2020, you'll realize India and all did nothing, China did nothing. It was back to NASDAQ and the technology shares. And because post 2008 this kind of money printing happened, they've extended the technology bull cycle, and it's an extended bull market there with excess money printing, which is going to lead to a crazy climax in the commodity complex, which is why the bulls who are in gold, silver, uranium think the prices are not going to be 20, 30, 40% up, but multiples up. That's also been explaining a bit of the rise in Bitcoin, because these are all anti-currency bets. That if currencies are getting debased and central banks, including ours, are not interested in letting us move a lot against the dollar or the euro and so on, what is the trade which can then counter for my loss of purchasing power? And that seems to be moving away to, first of all, it'll go to all these precious metals, uranium, which has great use now in what is happening in nuclear, and eventually into commodities, because your cost of mining, cost of labor is all getting inflated up. So yes, commodities is going to give you money which I don't think even I can calculate today.
Will it create a bit of an inflation problem then for India?
It is. So India is creating a problem for itself by holding the currency down. So our currency, I believe, is being held down with the mistaken notion that it helps exports. It doesn't. Because the next morning you get a call from overseas, from your buyer, who says drop your price because your currency
you're
is
getting
down.
currency benefit. Yeah.
What you actually end up doing is importing this inflation, because you're buying oil from abroad, you're buying all these commodities. So at one level, the commodity complex and banking profitability starts becoming superb in India, and then the currency, if it falls, it gives you supernormal profit over here. But on the other side, it makes the rest of the country, which is 95% of India, which is not exporters, poorer. So today, if 2 lakh crore dividend is given by RBI to government, it's it's a multiple of that which was effectively lost by the Indian public, who, if the currency had been stronger, would have had a bigger purchasing power to buy goods and services. So we'll see how this plays out, because eventually that arsenal of 650 billion is not there to provide dividends. It's to provide stability and price stability to Indian public. And I'm hopeful that RBI will be able to, as they have, manage the inflation issue very well.
Yes, that's a topic which is very close to Manish's heart, and every topic this will come out, and we can have, of course, a longer conversation on that. But one last question then. You said tripling of index every 10 years. That should be your broad horizon. We're at 23,500 roughly thereabouts. So in 10 years, we're talking about 70,000?
Yeah, look, from whichever point to point you'll take, you'll go 3 to 4x in every decade. There will be periods in between where you look point to point from the high to the low and say, this is all crap and I wish I wasn't in this market. And there'll be points you'll say from bottom to top, you'll say, wow, there's nowhere else to be. Reality is, the market will give you return equal to the underlying rate of return of equity which the company makes.
Earnings growth.
Which by and large is 15-20%. It can't be more than that. And that's what gives you that 4x in every decade. If you're lucky, you buy the best performing sectors and stocks, and fortunately some investors have done much better than that over time. But as an index level, if you multiply your money 3 to 4 times in every decade, that's good enough. In fact, oddly, that's the return gold has given for continuous series of decades. So it's really an anti-inflation hedge again. You have to buy equities when you think there's inflation. You can't be in fixed income. And it is a young country. We should be taking risk. We should be putting a lot more money into equities as a country. And I'm glad that the Indian public has made enormous money in the last 4 years. And that is setting the stage for this economy to grow faster over the coming decades. And as I said, the century does belong to our country. We are young. We are willing to work hard. And there's no reason that our progress can be halted.
Absolutely. Nitin Kamath, in fact, put out the data that, among his clients, they've already made 50,000 crores.
Wonderful.
And sitting on 1 lakh crores of unclaimed profit. Manish Chokhani, always a pleasure talking to you. Thank you so much for joining us.
Thanks for inviting me.
Well, that's all we have on this special edition of Market Masters.